holiday season for many, including myself, is the most wonderful time of the year. However, after celebrating a joyful Christmas and a happy New Year, the season that follows is the exact opposite of wonderful. Tax season. Unfortunately for us dividend investors, we are responsible for paying taxes on the income we receive throughout the year, which is like the one downside to dividends. And the amount of tax owed depends on the type of dividend you receive and your personal tax situation, which we'll be covering in this video. And I'll share with you a couple ways you can actually avoid paying taxes on your dividend income. So be sure to stick around for that. But first, a couple of things in case you're new to the channel. My name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, just a quick disclaimer, guys, I am by no means a tax professional, so please take the information I'm about to share with you in this video with a huge grain of salt and understand that this is just a compilation of information found browsing on the internet. Now, moving on and starting with the basics, there are two main types of dividends you can receive. There are qualified dividends and there are non-qualified dividends, also known as ordinary dividends. Qualified dividends are ones that you will receive from most of the bigger blue chip companies like Apple, Microsoft, Procter & Gamble, Johnson & Johnson, etc. And they come with the advantage of a lower tax rate or possibly even no taxes. Now, what we're looking at here are the tax rates that apply to qualified dividends for the 2022 tax year, so basically for the returns that you'll file in 2023. And from here, we can see that if you're filing as a single individual, so not married, you can basically enjoy a 0% tax rate on your qualified dividends if your taxable income is less than that $41,675 per year. And similarly, if you're married and filing jointly, you can enjoy a 0% tax rate if you're making up to $83,350 in taxable income. Now, moving on to this next bracket, the 15% tax rate, you can see that there is an income range here for both single and married filing jointly, where basically if you fall in this range of taxable income, you'll have to pay a 15% tax rate on your qualified dividends. And the same is true here if we move over to the 20% tax rate bracket. Now, one important thing to note here is that each of these different income brackets do include taxable income that you make from your W-2 job, or if you make money as someone who's self-employed or as an independent contractor. All of these things count towards your taxable income. It's not just the dividends you receive. So while you're still actively working and building out your portfolio, chances are that your dividend income will have some sort of effect on your annual tax bill. However, let's say that hypothetically you're married and you're retired, which means that you don't have any money coming in from wages or salary or anything else. All you have is your income from your qualified dividends, of which you receive, let's say, $80,000 per year. Believe it or not, guys, you would actually be paying $0 in taxes on this $80,000 in qualified dividends. And that's because of this right here, guys, the standard deduction, which shaves about $26,000 off of your $80,000 in dividend income, leaving you with a taxable income of $54,100. And if we refer back to the tax rates right here, we know that that $54,000 falls within that zero tax rate category because it is less than that $83,350 threshold, which is extremely cool to know, guys, that you could be making $80,000 in qualified dividends from companies like Procter & Gamble and Microsoft and Apple and pay $0 in taxes. Now, taking a look at another example, knowing that your dividend income will continue to grow over time, let's say that, a few years down the road, you're at a point where you're making $100,000 in qualified dividends every year. Well, even at $100,000 in qualified dividends, we are still paying $0 in taxes, guys. And once again, that is because of the standard deduction, which puts our taxable income at about $74,000, which is still below that $83,350 threshold. So even at $100,000 of dividend income, you can pay zero taxes. Crazy. Now, taking a look at one more example, guys, a few more years down the road, you are rolling in it. You're making $125,000 in qualified dividends. And with a standard deduction of about $26,000, that leaves you with a taxable income just under $100,000, which is above that $83,000 threshold, which would put us in the 15% tax bracket, as we can see here, which means we will have to pay some in taxes, $2,363 according to this. But still, guys, you could make probably upwards of $115,000 to $120,000 in qualified dividends and not pay a penny in taxes. Isn't that incredible? Now, keep in mind, guys, this is just the case for qualified dividends. Now, on the other hand, ordinary dividends, which you would receive from real estate investment trusts like Realty Income or business development companies like Main Street Capital Corporation, are a different story. The rates for these are higher than what you'd pay on qualified dividends and are the same as the standard federal income tax rates, which can range from 10% to 37% on the high end, depending on which income bracket you fall into. But it's still possible to avoid paying taxes on these as well when you stack them with qualified dividends. Now, as an example, let's say that you're making $90,000 of dividends every single year, 80,000 of which are coming strictly from qualified dividends. So $10,000 you're making are coming from ordinary dividends. Maybe you've got some real estate investment trust or you have some Main Street Capital Corporation. Believe it or not, guys, with this setup, even though you have some ordinary dividends coming in, you would still be paying $0 in taxes. Now let's kick it up a notch. Let's say you're bringing in $100,000 in dividends every single year, 20,000 of which are coming from ordinary dividends. Now closing this out, you're still paying $0 in taxes. And to show you one more example, guys, let's say that you're making $110,000 every single year. You're bringing in 80,000 of that in qualified dividends, meaning you have $30,000 in ordinary dividends. Now only here will you start having to pay taxes, which really isn't that much. Off of $110,000 in annual dividend income, you're only paying about $500 in taxes, which, like I said earlier, guys, I am by no means a tax professional, so huge grain of salt, but as you can see, it is very possible to avoid paying taxes on your dividend income through this avenue, but this is just one of a few ways you can do it. Another way, and one that will require much less calculation on your end, will be to just buy stocks in a tax deferred account like a Roth IRA, which allows your portfolio to grow tax-free, and after a certain point will allow you to withdraw money without being penalized or paying any sort of taxes whatsoever. Any of the money that you personally contribute to this type of retirement account can be withdrawn anytime without any issues, but there are certain rules you have to follow when it comes to taking out any of the profits that you made or the dividends you receive. The IRS considers withdrawals from a Roth IRA to be qualified only if you've had the account for at least 5 years and meet any of the following criteria highlighted here, with the first one being the most relevant for our purposes here in this video. One of the other caveats to the Roth IRA is that this type of account comes with contribution limits, meaning you can only invest up to a certain amount each year. This year in 2022, the contribution limit is $6,000 for people under 50 years old, and if you're over 50, you can invest up to $7,000. But this will be expanded in 2023, where investors under 50 years old can contribute up to $6,500 per year, and if you're over 50, you can contribute up to $7,500. Now, personally, I'm only 29 years old and actually opened up a Roth IRA for myself at the start of this year, and as you guys can see, if we take a look at my dividend portfolio tracking spreadsheet, my Roth is currently valued at just over $2,800, and I have this portfolio through M1 Finance, so it's set up to be super automated, super hands-off, and hopefully will continue to grow in the background just without having to lift a finger. And to make it especially easy on myself, I have this portfolio just set up with 4 different ETFs, so I really don't have to pick stocks or anything like that. It's super simple. Now, unfortunately, guys, this year, in my first year, I was not able to max out my Roth IRA, but I am hoping in the years that follow, 2023 and beyond, I will be able to do that. And if I can swing that, contribute the maximum $6,500, which actually probably will continue to increase over time. I'm sure they'll expand those limits. And accounting for a dividend growth rate of 8% throughout the years, along with share price growth of 8% on average, if we scroll down 30 years from now when I'm 59 and a half and able to actually start withdrawing these funds without penalty, I'm hoping to be generating just over $21,000 and should have a portfolio value of about $1.2 million, which is unbelievable, guys, because remember, this is all tax-free. That $21,000 don't have to pay a lick of taxes on it, and even the share price gains won't have to pay a penny in taxes. It's going to be great. And with that, if you guys want to use this spreadsheet to start tracking your portfolio, it's totally free, and you can get the latest version in this video right over here. Not only can you get the spreadsheet for free, but here in this video, I'll go through a full walkthrough to show you how to get set up and start using it and get rocking and rolling for yourself. So click right over here, and I'll see you in the next one.